our panel's called Go Big or Go Home, but don't go home yet, because we are going to have some big ideas about what's driving impact investing. I edit Bloomberg's Sustainable Finance newsletter that comes out every week, and we talk constantly about what is happening weekly. But this is what is happening over the long term, over months, over years, and hopefully more quickly as money has flown into this space. So Jameela, why don't I start with you and tell me a little bit about what you're seeing in sort of this push toward mission investing and how that's been such a big shift. I think Cambridge Associates did a survey earlier this year of 159 institutional investors, and nearly a third of them said they're currently doing mission-related investing. And of those, 44% have increased their allocations recently, and 62% expect to grow them in the near future. No one's planning to cut back of that group. So this is like Pandora's box, right? It's opened up.
Well, good to be here today. Thank you, Anna. Thank you, others who have put this on, and thank you. Yes, I mean, I think what we're seeing is a couple of things. I think we're seeing, driven by many of the organizations and great work from people in this room, asset owners, but specifically also private foundations, doing a real rethink of how they look at their assets and what that actually means. And so what you're thinking is, you know, this old model of making money over here and giving away over here is fundamentally outdated. And so while this is sort of a long-term shift that we're seeing, this is what is transpiring underway. For context, I work for Perella Weinberg Partners. I co-lead our mission-aligned investing work, and I work with foundations and endowments in helping them construct portfolios that are aligned with their mission, broadly speaking. And what we see, we have about 30 clients. Half of those clients have gone through a process around exploring what that means to them. And I think that's so important, is that when you've met, for us, one foundation, you've met one foundation. And when you've met one, university endowment, you've met one university endowment. And what mission-aligned investing means to them can be totally two separate things. So I think what we're seeing is this real fundamental rethink that is ultimately an extension of how an organization has impact.
Yeah, we've definitely seen investors say, well, look at my foundation, I'm doing all this grant making, how can I sleep at night if I don't know what's in the corpus funding everything else? So that is a big shift that we definitely will expect to continue to drive impact investing going forward. And that's changing things on the asset manager front too, Ron. So impact's gone sort of from a, what is it, to well, where is it today?
Yeah, so I got started in this space a little more than 10 years ago, and I came into it from having sold an investment firm. So I was very involved, financial services, wealth management, fell into impact investing in 2007 by investing our own family foundation portfolio, and started to evangelize the space at that time amongst folks in the financial services business. And so it's been an interesting journey over 10 years. And I think the big thing happening now is I really think that we're finally at a long-awaited tipping point in the financial intermediary space. So 10 years ago, when I started with this, I bring together a room of folks from the financial industry, and the question that they would have is, what is impact investing? And many of them would have misconceptions. Eunice had recently won the Nobel Peace Prize, so they'd say, well, it's microfinance, or it's community development finance, or it's clean energy. And not many of them kind of wrap their heads around the fact that it was all of the above, right? It was an entire investment category. Fast forward 5 years, and 5 years ago, I would say that the market of financial intermediaries, both asset managers and wealth managers, were beginning to understand impact investing, but many were still asking the question now, why? They knew what it was, but I would sit with rooms of financial advisors and I would say, how many of you have clients that would be interested in this? And very few would raise their hands. And then studies would come out from US Trust, and Merrill Lynch did a couple of really good ones. And it showed that well over 50% of clients were interested. So what it told me was that advisors were not yet even understanding the demand they had in their own client base. They weren't asking the right questions. Fast forward another 5 years, and I would say we're now past the what and the why stage, and we're to the how stage. Tideline just did a recent survey. 9 out of the top 10 asset managers in the US have developed or are developing an impact investing strategy, including BlackRock. Similar things, I haven't seen data similarly on the wealth management side, but I can tell from just meeting with executives at the top 25 wealth management firms that all of them are all of them are either doing something in this area or seriously thinking about it, and it's driven by client demand. It's driven by the fact that whether it's millennial clients, whether it's women investors, whether it's a combination of the above, clients are starting to demand this. And so for the first time, I think it's taken 10 years. I used to say that, these were the firms that are all the gatekeepers, right, between the investor and the investment. And I would say that for the better part of 10 years, our collective gatekeeper community, of which I was one for 30 years, have kept this particular gate closed. They've used fiduciary standards as an excuse for why they couldn't move into this. They've not educated themselves as well as they should have, so they didn't have the credibility to understand it. And I really think that that's changing today dramatically. And I think looking forward a couple of years, we're very quickly going to be getting to the point where if you run a major financial intermediary firm, whether it's an asset manager or you're involved in the client wealth management side, and you're not strategically thinking about impact investing, then you're going to be behind the curve.
Part of this is the growth rate in the space too, right? You look at all asset managers are looking for growth and they want to attract capital. And you look at, the traditional exclusionary SRI investing or the ESG strategy, but the fastest growing one in all of those asset classes is impact. Constantly, that's what they're saying. And can I ask you about millennials too, Ron? Is this really something that they're trying to appeal to millennials?
Absolutely. So we have 2 millennials on our team, and they spend, and it's kind of interesting because our daughter Stephanie and our portfolio director both joined in 2014, Stephanie from a different career into the foundation. And one of the first questions they ask is, why weren't we 100% invested for impact? We were pretty proud of ourselves. We were like 35% invested for impact, which, as I understand the math, is 34.96% more than the average foundation, right? So, but yet their perspective is, why would we invest any other way across our portfolio? So what we're seeing today, good news is that the interest of millennials, and we're seeing it at the Nexus Global Youth Summit, a lot of different areas, the interest is just off the charts. Few of them have any assets to invest yet.
That's the problem, isn't it?
So where we're starting to see real movement is millennials that are getting seats at the table at multi-generational families of wealth are now being able to start to influence decisions. But what I'm really hoping for is the kind of the forthcoming democratization of this, where millennials will be able to go into their 401ks and pick sustainable investments. The rise of platforms like Swell and Ethic, who was just here at the last panel, that are giving folks an opportunity to build portfolios. I think that's the drivers. I talk to wealth managers too. It's about, I look at this as in the enlightened self-interest of everyone in the financial intermediary space, right? This is an opportunity for these firms to do something that has this virtuous circle. It's good for the world, and it's also very good for their business. And I say to a wealth advisor, if you plan to be in business 10 years from now, then you need to start looking at what the clients you're going to be increasingly dealing with are interested in, and right at the top of their charts is impact investing.
Yeah, it's great that you brought up these multi-generational families. When we talk to them, sometimes the parents say, oh my gosh, my kid is excited about impact investing. They want to talk to me about their investment portfolio. I've been trying to talk to them for years about it, and this is finally an opportunity to do that. And I want to go to Debbie and talk about BlackRock and what you guys are seeing there. Obviously, there's been lots of changes at BlackRock this year, in the past few years in this space. I thought one thing that's interesting about impact, and I'm constantly talking to impact investors, is they always say, how do you measure success? How do you measure your actual impact? It's easy to measure financial metrics. I used to be a financial accounting reporter, so there's lots of accounting and stuff built up about that, but it's very different in sustainability and impact, and I feel like you could talk a little bit about what's happening there that'll drive impact investing going forward.
Sure. I mean, in this concept of bold ideas, I'd put forth to the group here that insights really matter, and I think as it relates to impact investing, we ideally want to think about the issues underlying how we would put a portfolio together. So I thought quite nicely, Jay and Jason in the previous panel had some kind of things to say about what information do we really know and what information might we want to put into a portfolio. That's been a significant area of focus at BlackRock. So BlackRock is a very big firm, I'll locate myself in this big morass for everyone. We have about 135 investment teams at BlackRock. I am in one of them, and I lead sustainability impact investing for our quantitative team. We're based in San Francisco, somewhat unusually. And because of our approach, which happens to be very quantitative, insights matter for us, and so does measurability. So everything we do, I sit inside of what is effectively the data science team at BlackRock. We have our own internal team that does machine learning and natural language processing. We've developed this team over the last decade. Part of why we are in San Francisco is we're getting the best of talent that we compete kind of directly with tech firms. What this allows us to do in the insight arena is, as we think about and want to decompose different societal issues and then figure out, I'll come to the second side of insight, which is portfolio construction, what to do with these things, we actually need to do a fair bit of research. It's been noted, I think many people are aware, that there are constraints today in the amount of information that is made publicly available by companies. And so we think that there's quite an imperative to drawing out more insights about how companies and society are interacting. And then, in my case in particular, though we have 135 investment teams, so there are other styles of investing, but as a quantitative investor, systematic investor, I have the pleasure of numbers and comparisons at all times. So I can actually uncover information, perhaps unstructured information. So for anybody who doesn't work with information and data a lot, a structured data set is something that I could probably find, purchase, or it's online. An unstructured data set is just an existent body of information that hasn't been put together and primed. It turns out data scientists and people working in the technology space excel in structuring unstructured information so that it's usable to derive insights. And so that's one of the really important ways in my work that we're able to measure and quantify what's going on. Just to round this out, the second side of insights that matters is portfolio construction. So we are working to develop return investment portfolios that also have these measurable and transparent impact outcomes. Jason nicely brought up a story of the CEO of my firm, Larry Fink, just a few moments ago, for those of you who were in the room. It's interesting, at the very same time that that dialogue was going on, I was actually joining the firm. And a reason I came to the firm was because of the forward-leaning climate work that was happening from a research point of view in my team. So of course, in a large firm, it's the case that many things can be true at the same time. I'll be very technical. I'll be very technical about why what I think our CEO said had to be accurate. If you are constructing a portfolio, and I will go into detail just for a second, I'm sorry for anybody who doesn't work kind of day-to-day in finance, but this is important. The way that Jason recounted the story, I think I would actually, even as someone who has deep climate insights in the portfolios I manage, have to answer the same way. If somebody asked me, what do I do with climate in the abstract? I would say, it depends on a lot of things. What kind of portfolios? Equity, debt, global, US, emerging market? I would have so many questions. So actually, if I were CEO of my firm, I'm not, I probably would have to defer to that is a big factor to be applied generally. In the specific, it can absolutely be applied, absolutely matters, sits in portfolios. The Journal of Investment Management quite nicely has just accepted a paper that my team has put forth around climate and research. So this is an active, robust area for research, just in the scope of insights and how we think about measurement. It matters to fully inform ourselves around topics. We continue to do heavy work on a number of topics. And then we have to make portfolios. That's the second part of delivering insight. Insights matter is the bold idea I'm putting forth. So once you have the ideas, you still have got to put these things in a smart construction for investors.
One area I feel like we've seen a lot of insights develop is in scenario planning lately, and a lot of more portfolios are sort of being launched in this, let's plan out the 2-degree scenario, let's see what happens. And there's a lot of other impact issues where that can happen too. I wondered if you guys were doing anything in that area too.
Sure, I'll speak briefly on this. We've obviously just hired Brian Dees, who worked a lot on climate during the Obama administration era. I also worked, but not as a political appointee, but as a presidential appointee of President Obama at the State Department in the lead up to the climate talks and Sustainable Development Goal work. So certainly there's a lot of scenario analysis and technical information available on how can you play out different scenarios. We certainly have an active research agenda in my team thinking about climate and weather pattern changes, what that might mean. BlackRock as a firm, through our BlackRock Investment Institute, published a paper around climate, not a product paper, but just how might you think about these issues. And I would note one issue. It's an opportunity really for investors, all of us in the room, and across asset classes, not just in the listed equities where I happen to work right now. The transition of economies over time to be more green and to be more climate aware is one of the more significant but understated opportunities. So the climate change framework has 3 components: adaptation, mitigation, and resilience. Mitigation is what many people focus on, carbon emission reduction. That is hugely important. There are degree scenarios around that. It is more difficult to run scenarios around adaptation, which is how does the economy change? What new goods and services will have to exist, and what new infrastructure will have to exist for our economy to be more renewable and climate aware in the long term. That means there's necessarily opportunity for investors in that space. It's not something easy to model. We see some businesses starting, some are succeeding, some are not in that space. And then I'll just round this out. Resilience does tend to fall into the government and non-government realm, because this is often dealing with how people are being directly impacted by climate. So companies have a role. It could be more difficult to measure directly in a portfolio construction the role that companies have, when really the pools of money for helping people will be in nonprofits and government.
Great. Brace, I wanted to go to you. One of the other big themes driving impact is sort of this ability to make your portfolio matter to you. Uniquely. And it seems like, investors out there, they personalize their music collection, they personalize their salad. Why not your investment portfolio?
Yeah, I think this is just a natural carry-on from what Ron was saying. If you look at the history of investing and finance over the last 50 or 100 years, there's been, significant changes in how people have thought about how they build portfolios. Diversification isn't all that old. Value at risk was only established in the 1990s. And I think today what we're seeing and we're appreciating is, as we think about how we consume other products, people want to personalize how they think about their financial assets. And I think one of the impediments that has occurred in this impact sustainability world is the vocabulary has gotten in the way of this. These are very personal decisions for all of us. Some of us care more about the environment, some of us care more about social issues, some of us care about gender issues. And I think we are right at the inflection point where it's possible and necessary for asset management firms to be able to provide individuals and institutions with, 3, potentially equally weighted choices. We can understand what our return preferences are, we can understand what our risk preferences are, and we want to understand what the value and mission, sustainability, impact characteristics of our portfolio are. And if we thought about those 3 things, we should be very acceptable and very happy with whatever that outcome is. And this fixation about what's a market level return, I think is really not a sensible conversation. If we all understood and we had the ability and the data to be able to look at what those financial assets represent in the topics we care about, then I think that's where the industry is going to go, and it's going to be personalized. I think this is going to be a very unpleasant and significant disruption to major providers of this service, because the industry was built and predicated on scaling a product, and they were taught that you get a higher margin if you sell as much as possible to as many people as they can. And so you try to create that silver bullet that everybody thought was good. Well, there is no silver bullet impact fund, or there's no ESG fund. It means different things to different people. And so I think it is probable that the players, whether it's Epic or it could be Facebook and Google, are going to be the ones that are going to personalize those opportunities and disintermediate the classic providers, because they'll be providing the consumer what they want. They want and understand what the characteristics and that mission and value alignment. And we've seen it in other parts in the world. One of the fastest growing investment pools is Islamic finance. Sharia is a mission and value investment thesis. So we're not breaking any new ground here. So.
I wanted to ask all of you sort of what's an obstacle that sort of gets in the way of these big ideas? What's something that this group as a whole sort of has to work to overcome? And Jameela, maybe you're working on the mission investing, because we're not there yet. These are the big things for the future. So what's some of the obstacles?
I think generally there's a resistance, for us as humans, a resistance to change. And getting over that hurdle, if it's internally in the context of working with an investment committee or a board of trustees, or even internally in the context of my own team or other financial firms, there's a resistance to change that is innate in all of us, I think, sometimes. And as a result of that, that is one of the big obstacles we have to get over. I think a lot of it comes from, and what I hear sort of the running theme from this is like, ask the question, ask the question, ask the question. And it all starts with asking the question. And I would encourage, you've heard it sort of reiterated today through so many different panels, but as an advisor, I'm leading the way and we're leading the way somewhat, but it's also the questions that we get from our clients are pushing us further to be able to dig deeper into the data, to ask the questions of the managers in which we're allocating capital to get them to write information, to be able to use the insights, to be able to define and construct portfolios that are more aligned with what they want to be doing. So I think a lot of it is asking sometimes even the simple questions can actually have a monumental change, but sometimes it's the old thinking and the resistance to change that's the obstacle.
Yeah. Brace.
I guess I'd say a similar thing. I don't see there's an impediment. I think we're right in the middle of all of this happening. We're watching it as we speak. And the large financial intermediaries are either going to change. It's hard for them. They're very, there's lots of people. The advent of big data and technology to be able to disintermediate what people do is going to be an unpleasant process. There's going to be a lot of jobs lost. I think I grew up in my career at Goldman Sachs, and if you think about the people that were doing equity research, I think a lot of that will be disintermediated by computing technology. So, I think part of the dilemma is we're going to create unpleasant transition, and that will be difficult, and people resist that. Making big financial institutions smaller is not anything that anybody enjoys, and it's not an easy thing to do. But that process is happening, and so I think we will need to hold companies accountable, because public policy was said in the last panel. I think public policy is failing us in a lot of ways, and the capital market historically has been a pretty good adjudicator of what people want. So let people give the chance and let everybody vote. And in a perfect world, one of the panel said if everybody had some of their dollars in the game voting on what they cared about, I think the aggregation of that would be a pretty good adjudicator of what we all think is good for society. And that will be disruptive and painful in some regards, but really important, particularly with the abdication of good public policy here in the United States and other places.
So I'm going to kind of follow on what Brace said and say that I think from a gatekeeper perspective, the fundamental thing that's happened is old habits die hard. Those of us that came out of the financial services space, people that were trained in the investment world, were classically trained on two dimensions, risk and return. It's kind of ironic that the concept that we still all work with today of modern portfolio theory was actually originated in the 1950s. So it doesn't seem so modern anymore. But there's 6-7 decades of very traditional ways of investing. And now what we're doing is actually adding a third dimension, risk, return, and impact. And one of the things that I'm concerned about is that the natural way for firms to try to add that third dimension is just check the box. Okay, we got a couple of these impact things on there. And I actually think that from the perspective of those firms representing the client, it's got to be more about process than products, because to Brace's point, folks are interested in impact, but their definitions of impact are very personal to them. So I still have to laugh. When I got in the business in the early 1980s, it was a very domestic-focused industry. There weren't a lot of international investment opportunities for most investors. And then international funds and international products started to be developed. And kind of in the same way, so if an investor was interested in international, they wouldn't come to them and say, well, hey, we've got a fund that's located in southern Estonia. Are you interested, right? But yet we're doing that for impact. We're saying, well, you've said you're interested in impact investing, so here's a fund that invests in X. Well, X might not have anything to do with what that particular client or family is interested in. So process is a lot more difficult than product. We've all been taught how to build and scale products, but developing a customized, personalized process for this is more difficult. And I think to Brace's point, technology is going to be really helpful there because it's easier to mass customize today than it's ever been, and it's going to take some really interesting combinations of technology and personal solutions to make that happen.
Yeah, I think that's a great point. I've seen a lot of people, or just one of my, I think the most powerful ways I've heard ESG and impact in this whole space described as sort of an innovation on portfolio theory, that you map the future instead of modeling the past. So it's interesting to see that develop. Jameela.
Sure. I mean, I'll say that the obstacle and the opportunity is along these same lines. I've talked about insights. Finding more information from companies in comparable ways is actually something that's quite important to this democratization process. So it's very nice that I sit in a team in San Francisco that has a lot of data scientists, but it ideally would be, and certainly we at BlackRock are highly supportive of advocating for more disclosure of information from firms so that many investors can consume information. I think right alongside that, an obstacle, but also opportunity, is really the teaching process. So, Ron and Brace, you've said well, and Jameela, there's a lot of teaching and learning that needs to go on. There are groups of investors who are quite sophisticated all over the world, who I've spent time with, not about any product, not about really anything, but conceptually. Now, if you would like to construct a large pool of capital in a certain way, how would you do that? I used to work at the endowment at Stanford, so actually taking the full portfolio view and saying, if this is an issue you'd like to wind through multiple asset classes over time, what would that really mean? And so there's a lot of just really deep thinking. Philosophically, what does an individual or an institution want to do and why? Then what is in the realm of possible, and then when you find things that aren't possible but are of interest, figuring out where to find that. So this is actually a pretty intricate and heavy time investment process. Not all investors have the time available to do this or wish to commit such energy to the process. So there's some reckoning there.
One of the really interesting things about impact investing is sort of being able to marshal capitalism and marshal the capital markets to do things and perhaps achieve some of these goals that people have been working toward for years at a more urgent or more rapid speed. I was curious how you guys see, when you look at this space and the big ideas, what's the time frame for achieving some of these goals? We have like the Sustainable Development Goals out there. There's lots of different ways that impact investing can be used to sort of get the universe where it's going. Jameela.
It's a big question.
It is a big question.
And I think to the point about process is a lot about patience and a lot about sometimes taking a step back. So in order to achieve the goals or sort of the big ideas here, I think a lot of it is actually happening faster than we anticipate. I think a lot of it is actually being driven by, as we heard from Ron and others on other panels, young individuals asking these questions, or the next generation, and also having women in decision-making roles as well, I think is a huge difference. I think what we see is the client across the table from us changing, and that client is changing actually pretty fast. And what I mean by that is the makeup of the individuals are from different backgrounds and more diverse backgrounds than they were 10 years ago or 5 years ago or even 20 years ago. And as a result of that, I think that's accelerating the change in order to where we're going.
Go to Ron.
Yeah, I was actually going to use the same word. I think the pace is accelerating. It's been candidly slower than I would have hoped it would have been when I first got in this 10 years ago in 2007. But I've really felt an acceleration over the last 2 to 3 years, and I'm very hopeful that over the next 3 to 5 years, I love the SDGs, but I'm hopeful it won't take till 2030 for us on the impact investing side to see lots of more capital put toward these areas. And I really do believe that with what's happening with the financial intermediaries and others and millennials and women investors, we've just got a lot of things, and institutional investors that are really coming forward in a much more meaningful way, that the next 3 years can be really, really powerful.
Yeah. Brace, what do you see?
Well, I think you're seeing this really play out quickly in that the market today, we all, I think, can observe that we are holding companies accountable in a way that we didn't hold them accountable before because there's more information about how they behave. And it seems very clear to me that the market is now defining guardrails of conduct, and it moves. And when companies get either near or over those guardrails, at some point in time, the market gets really angry and penalizes them, whether it's a Volkswagen or Miramax or whatever. When we look at something, and those stocks fall hard and fast when we collectively believe that an institution is behaving in a way that we don't like. And so it seems to me that the capital now is very clearly in reinforcing corporate behavior and penalizing them when they don't do well. And if we all are participants in that kind of license to operate that a company has, and that license we are seeing can be taken away very quickly, either by the consumer or by the regulator, the moment it gets out. And one of the things that, this is what markets do, is it's not so clear what the tipping point at any moment in time that it happens, but it is very observable that companies that have, kind of bad or behavior patterns that the market doesn't like have a much higher probability of making a business decision that the market doesn't like in the future. And then they see a dramatic change in their cost of capital and, poof, there's a change in behavior. So I think, is it happening as fast as we'd like? Maybe not, but I think it's happening a lot faster than everybody thought. And all you have to do is turn on the news every day and see how, various organizations are changing how they operate at a time where no one would have even considered 2 years ago or 3 years ago that could happen.
Yeah. And given the political environment too, that seriously puts the onus on companies to take a viewpoint in ways that I don't think we've seen them come out on so many political issues before like they have in the past few months or year.
And they're clearly highly incented to get this right because they are penalized in the market quickly if they're on the wrong side of this.
Yeah, or by their employees too.
Or by their employees, by their employees as well.
Debbie.
Sure. I'll approach the global development side, since you've mentioned the SDGs, and then come to some of the particular in execution for financial markets, as many of us are involved with them today. I have had the great fortune of spending much of my career living and working in the emerging markets, and I couldn't be more encouraged by the flow of capital and the texture of that. Was inspired a couple of years back to write and teach a course in Stanford's MBA program about frontier markets and investing. The reality is, it's been said, and it's right, there is a significant uptick in the realization that there's a lot of growth taking place and a lot of important issues that are addressed as companies grow. The beautiful thing is jobs are created, and it really does help address a number of societal ills, not all, but the corporate interaction and just a firm interaction has a lot to say around the Sustainable Development Goals. So the human development agenda, people's basic health and welfare, has been tied together with the environmental agenda in the 17 Sustainable Development Goals. If you've not read them, they are actually a beautiful thing. 17 SDGs and 169 indicators is a lot, but actually if you feel like spending a few hours to read them, this is an encompassing way to think about humanity, and companies have a fundamental role. I mean, we're all just human, living in the same space, which is pretty confined, roughly, and living in a global economy that's highly connected. So I'm encouraged by institutional capital and investors who had not typically thought of what is my role in the global agenda, finding a way to attach to it. That would be my encouraged comment there. And then in the very particular, in the financial markets as they've developed kind of now, if you think about, what's our job as BlackRock, Big B BlackRock, a very large firm, we're thinking about people's financial futures, and that means we necessarily need to take in long-term value creation as the thing that we're investing for. And for us, that does mean conditioning the traditional risk and return view, which is the finance theory view, with a lot of other information that we are able to gather. Call it impact, call it sustainability, many names are out there, but we want as much information as possible to condition how do we think about investing in an asset on behalf of others so that they would have better financial futures. So again, I'm actually pretty encouraged. I think that overall, those of us who are in the investment industry are in pretty thoughtful ways trying to take these issues into account. So I don't see 2030 on the horizon. I'm actually very excited about this work today.
It's definitely, I don't think we've ever seen a time where long-term issues have been talked about as much in the sort of, I mean, obviously activists are busy too on the short-term side, but the long-term side is really interesting.
I just wanted to follow up on one thing that Debbie said, that I have been really impressed. Who'd have thunk that the UN could have come up with the branding and marketing coup that they did with the SDGs? I mean, it's only been since, what, September of 16, I think, that they came out?
Yeah.
And originally, when I would talk to other folks in the financial space, half of them referred to them incorrectly as STDs, you know? But now, I got to tell you that they've created these really interesting organizing principles, and more and more firms are now starting to develop products around specific SDGs, and it's just helped people kind of think through the fact that impact investing has a wide scope, covers a number of different issues, and also the interrelationships between them. So I really have to give credit to the UN and the creating these world organizing principles around what impact can look like.
Yeah, clean energy diversity is like much clearer than I think ESG or SRI or anything in that alphabet soup that they call. Great. Do we have any questions from the audience for the panel? Then I guess we've reached
We're standing between them
Yeah.
and a
go
drink.
home part.
Yeah, we're standing.
Thank you so much.